1099 income isn't a mortgage obstacle. In fact, there's a program that just goes off the 1099 and doesn't even ask for your tax returns. Most lenders are still trying to shove freelancers and independent contractors into W-2 boxes. It's outdated and it's costing borrowers big. If you're submitting tax returns as a 1099 borrower, you're likely hurting your approval chances, and one simple change could unlock your path to real estate riches. I'm Andrew Russell, owner and founder of RCG Mortgage, top originator across the country, 3-time Broker of the Year winner, and I specialize in working with self-employed clients, entrepreneurs, business owners, and those who receive 1099s to unlock the path to financial riches. One of the first biggest boo-boos I ever made in the mortgage industry, I actually started in the business right around the crash, and I was working with a client at the time. We were buying leads, internet leads, for across the country for those looking to purchase homes. And I remember a young lady, she had an amazing job. She made $10,000 a month, $120,000 for the year. I got a copy of the pay stubs, and she was looking to buy a condo. So it turns out that I pre-approved her based off that 10 grand. Mortgage payment's about $4,000, no real debt. Cool, easy peasy lemon squeezy, qualified all day long. Once her loan application, when she got into contract and we applied for the official approval, went into underwriting. This is again a long time ago, disclaimer, she actually got declined. Why was it? Where did I go wrong? I don't understand. $10,000 a month. What am I missing here? So it turns out she was a 1099. Now, for whatever reason, in all my training when I first started, somehow was left out the difference of 1099 versus W-2 income. So her 1099 income, her $10,000 a month, doesn't even count. It's like cash. We had to ask for a copy of her tax returns. And on her tax returns, she claimed the 1099 through her Schedule C as a sole proprietor. I'll never forget, I saw on the bottom of her Schedule C the $40,000 number. 40,000, the numbers, and somehow that $120,000 was wiped away, and that $10,000 a month of qualifying income, which is $120,000 divided by 12, turns out it was $40,000 divided by 12, 33-ish hundred a month. And I never forget the underwriter called and said, "Hey Andrew, unfortunately I'm gonna have to decline your XYZ client. The reason is the mortgage payment of $4,000. They actually only make $3,300 a month. They'd be eligible for a $1,600 payment, so they're gonna be declined, unfortunately." And I was lost. I was like, I don't get it. They make $10,000 a month. I supplied pay stubs every month, $10,000 every single month. How can we not use it? I had a teacher making $100,000 a year. Now this young lady is making $10,000 a month or $120 for the year, and they got declined. I don't get it. They said because when you're self-employed, the 1099 doesn't count for anything. It's considered cash. What counts is the Schedule C, which is the section in the tax return for a self-employed sole proprietor to claim their income typically. What counts is the profit. So there's the revenue, there's expenses, and there's profit. So the lesson learned, it was probably one of the biggest mistakes I ever made. We ended up having to pause her buying, wait till the following year to review her tax returns to make sure she didn't claim too many expenses to qualify. But the point is, super embarrassing, and I still remember that to this day. And it's a huge issue in the self-employed world. Specifically, if you're a 1099 contractor and you talk to any salesperson in the mortgage space, it is something that still, mistakes are made on the pre-approval side, where it's not the amount they're making every month. It's not the amount they made last year on their 1099. It's actually the profit. So turns out if this borrower would have fast forwarded to today's day and age, there's an amazing new program based off just the P&L. So the non-QM mortgage space has a sub-product based on 1099s. So instead of looking at tax returns, we would look at the last 2 years 1099s for this young lady and her year to date, which again is always the same, literally $120,000 for the year, $120,000 for the following year, and year to date $10,000 a month for however many months it was. So there's a program where it only takes a 10% expense factor. So if you think about it, if you have $80,000 of expenses, that's what, like 66% of the income is expense. There's the program now for non-QM for a 1099 program is it takes 10% off the top for expenses. So instead of 120, it's like 108, something like that for income, about $9,000 a month. She actually would have qualified, but that's the problem. Back then in 07, 08, 09, at the crash, everyone kind of, subprime went away. People started doing more FHA loans. There was no fantastic option for self-employed clients. So once this option came out, this non-QM loan product offer 1099, These type of clients are taking advantage in droves, and the product itself is exploding. But that's only because there's been a huge need in the marketplace. And I will never forget, my first biggest mistake was off of a 1099 client, but never again. So of course, Andrew, it sounds so easy. You just get 1099s, almost like a W-2 and no tax returns. Are you sure, broski? Is this actually a thing? Yes. So just remember, and I always say in all my videos, he or she who offers the money out makes the rules. So instead of going to Fannie or Freddie or FHA or VA, the non-QM side, whatever the end lender investor is, they're going to make the rules. So on a 1099 program, what are the rules? It's their rules, so we just follow them. It's get the 1099s, which is similar to a W-2, so just get that document instead. And you get their year-to-date, which could be pay stubs or verification of employment, a form we send to their company that they're a contractor for. And that's what we're going to go off of. That's their rules. We go off of that minus a 10% off the top expense factor haircut. So again, if you're making $200,000 as an example on your 1099, 10% off the top, $20,000. So we're going to give you credit for $108,000 of income. But I bet you if we did the old school method and looked on their actual tax returns, that $200,000 would be written down to 50, 60, 40, 80. So instead of using that, we use this new program. But again, he or she who offers the money out makes the rules. It's one of the easiest programs that we offer, and that is the guideline. There's no chicanery. I'm not pulling the wool over your eyes. It's just a new program that's come out, and it's definitely been improving. But Andrew, clearly, it's so much easier. No tax returns, no crazy CPA letters, no, profit and losses necessarily from the borrower, from the CPA. What's the catch? The rate has to be so much higher, right? It's actually not. If the going rate is, say, 6.5 on a 30-year fix, this program might be at 6.75. It's very close. Again, before the pandemic, when these programs were very popular, the rate was very close to the average rate for, say, 2 teachers putting 30% down with 800 scores. I always use that as the best analogy. Whatever that program is probably the best rate in the country. The rates aligned at the time. Then, of course, COVID happened. These programs came off the shelf with concerns with the economy. When they came back, when they started to come back, if the average rate was at the time was a little bit higher, say 7.5%, these programs went 9.5%, 10.5%, which is very difficult for the American consumer, where just a couple years back, they were in the 1s, 2s, and 3s. To hear 10.5%, it was very difficult for them to kind of sink their teeth into. That's going to be their mortgage rate. But eventually, they became closer. So right now, in the here and now, mid-2025, going into the fall, these programs are pretty close to what a conventional 20 or 30% down interest rate is. They're very aligned. Why? Because these programs typically have 20% down, so there's a little bit less risk because there's higher equity position, where conventional loans allow 3 or 5% down. So the end lenders love that, number one. Number two, the credit score requirements, a little bit higher, definitely into mid-upper 6s, but typically we see clients in the 1099 programs have scores in the 7s, so greater credit profile. And post-closing liquidity. What does that mean? If your mortgage payment's $5,000 a month, 12 months of that in the bank for a rainy day is $60,000. So if you close and you have 12 months, a full year's worth of payments in cash in the bank, lenders love that. Why? Because it's just a cushion. They don't want you to pledge it. You don't have to do anything with it. But just the fact that you have it left over is a huge plus. And why these loans, number one, clients are paying, they're performing, meaning that borrowers that are getting these loans are paying these loans on time, which lenders love. And number two, and because of that, lenders will offer better pricing to incent this type of client. Instead of taking a tax return program, getting a conventional mortgage, they want you to do their program. The 1099 programs, how are they going to do that? Obviously with a more attractive interest rate. And of course, hey, Andrew, the loan has to be shady. I bank with XYZ Bank. They're a big bank. How come I can't walk in, talk to my banker, and get the loan where all my checking and all my savings money is? So something must be wrong, right? No. So some lenders offer Fannie, Freddie, FHA, VA loans, specifically the big banks, mortgage banks, credit unions. Some lenders have portfolio loans, say like credit unions. Some lenders offer non-QM loans, typically non-depository institutions. And because they offer them, we as mortgage brokers, as an example, have access to all those lenders. So it's definitely prudent if you're getting a non-QM or a 1099 loan or a bank statement loan to inquire with a loan officer who works at a broker company, because they have access to all the non-depository, meaning like you're not going to open a checking with this company, but they offer mortgages, certain mortgage products, specifically non-QM. These are the lenders that are offering them. It just hasn't hit the big box, the big bank retail space as of yet. All right, guys, so I'm going to show you 1099 contractor income, the differences of how income is reviewed off of a tax return for conventional or FHA or VA type mortgages, and why it was just so easy with that young lady, if Back to the Future, right? If she would have purchased right now, the differences, you're like, oh my God, that's so crazy. It just wasn't an available mortgage product. But before we do, make sure you go in the description, click the link, get our cheat sheet for self-employed income analysis, our non-QM cheat sheet. We spent so much time preparing this for you guys because, again, to me, this doesn't sound like Greek, right? But it's all Greek to you guys. It's a lot, especially in one video. So make sure you go to the description, click the link, get the guide that we created. It's free, and it's going to have a complete overview of everything I'm going to say. So first, let's go off of a Schedule C. So Schedule C, the vanilla way, we'll call it. So the Schedule C, so this is the section of a tax return on a 1040 or your individual tax return for a sole proprietor that's going to show their 1099 income. And then the biggest thing is if we go backwards, forwards, the net profit is down here. So right here, it says net profit, number 31. That's the number where, if you remember, it was 120,000, then 40,000 down here, and it was very bad for your boy, aka me. Lesson learned, never made a mistake ever again in my illustrious mortgage career, but I will never forget that I was like a bull in a china shop, so excited to work with this young lady, but I didn't slow down and kind of say like, oh, 1099 side. So here we go. So here's the name of the actual proprietor. So like the business name is typically right there, outside of that, where the business is, all that good stuff. Sometimes the business has an EIN number, its own actual business or IRS tax identification. Some of this stuff is very, basic for the tax return, but it's not as important as if you start getting into part one. So the income right here, this is the revenue. So if you remember, my client made $120,000 in the 1099 portion of income. That's where it went. Returns and allowances, cost of goods sold, some of this more often than not is not applicable. So to me, if you add 5 and 6, gross profit, subtract line 4 from line 3. So ultimately, 120 is really this top number. This is what I was working off of. But I made a mistake because they were 1099, and I remember there was all sorts of write-offs in here. So if this number, backwards, forwards, if she made net $40,000 in profit, that means this section had to have $80,000 in actual write-offs. So for instance, car and truck expenses, say there was $20,000 here. Office expense, maybe there's $10,000 there, so we got $50,000 less. Maybe, deductible meals and entertainment, maybe in her actual role is a lot of money being spent there, another $20,000 for instance. So that's 50, maybe here. Another legal and professional, maybe she had 10,000 there. So that equals 2, 4, 5, 60. So we're missing 20. But there's actually a guideline that the meals and entertainment, you can only write off half of that. So we actually have to double that. So now that 60 turns into 80. Because there's so many guidelines on the back end of qualifying someone for Schedule C, specifically expenses. Some of them, like depreciation right here, even though it's an expense, you can add it back to this bottom line of income because it's a paper type expense, doesn't really count. Meals and entertainment, you actually have to remove it another time because it's IRS tax code, we can write off a certain portion. So if it was 20, 40, 50, 60, and then another 20 because we had to add this again, that equals 80. 80,000 expenses off the top of 120. Here's your $40,000 net. So $40,000 net, if you remember, she wanted about a $4,000 payment. So even if she had amazing credit, no debt, this is about 33, let's round it up for good favor, 34. So that's about less than a $1,700, we'll do mortgage payment, would have to be less than $1,700. So she didn't qualify after the expenses. So unfortunately, we were gonna say we right now in 2025. So say we would have had to wait to the following year, to 2026. Maybe we would have said, hey, listen, for this year, you're not gonna write off all these expenses. Unfortunately, this is gonna go up. Maybe it goes up to 120. That means you're gonna have to pay tax to the IRS off that because they don't collect. She's making $10,000 every single month. So maybe you have to, shell out $20,000, $30,000, $40,000 in IRS tax obligation for monies owed, but you would qualify instead. Now, before I show you guys again the 1099 program and how much easier it was, and I wish it was available for this young lady, just remember, description, hop in it, click the link, get yourself the cheat sheet for non-QM income for self-employed. It's super important that you grab that now, guys, just because it makes this whole process super simple and it's free. So make sure you hop in the description, click the link, and grab it. So, good news, bad news. Bad news is it was so easy. If we just would have flipped her back then into this 1099 program, I want to show you. You saw the tax return, and there's so much going into it, but like we showed, the 120 went to 40 for profit. It went to 33, 33, 34-ish a month. And unfortunately, she was looking for a $4,000 mortgage payment, which really would have need to show probably at least $9K a month. So in my head, this 120, she made $10,000 a month, but it was 1099 income. And because of that, we need to look at the Schedule C. And after we looked at Schedule C, there was 40,000, just didn't work. Now, if this program would have existed, I just want to show you how easy the calculation is. We don't need the Schedule C. Don't even have to show you much because say this is 2025. Last year was, very good class, 2024. And the year before, 2023. So if we do here the 1099 program, 2023, she made 120,000. Cool. 2024, she made 120,000. Awesome. Year to date, if this is now 8/1/25, for instance, 7 months, she made 70,000. So if you show year to date average, you always look at first to make sure it's not trending down. 70,000 over 7 months is 10,000 a month. 120 over 12 months, 10,000. You see, you catch the drift. She is consistently making a $10,000 a month of 1099 income. So we don't just stop there. We actually take that 10,000, we take 10% off the top for expenses, which is a 90% utilization number. So instead of $10,000, if you remove 10%, which is 1,000 off the top, you're left with 9,000 a month of usable income. So as you see, just that simple. There is no catch. It's just 1099 program, which is a non-QM. That's what we love here, baby. So non-QM has this new program called 1099. 1099 programs, we're going to use the face value of the 1099 and then your year-to-date income for your 1099 contracting position. Off the top, that 10,000 a month, which is in the case of this specific client, which was this young lady, we take 10% off the top for expenses. So that leaves you with $9,000 a month of income. So over here, you had 34 of income, which qualified no more than about $1,700 a month. So for here, this, assuming no debt, you have a max qualification of a little less than half of that. Let's call it $4,500 a month. So she wanted $4,000 a month. So as you can see, this is the best program for 1099 clients, only because you just never know what the Schedule C is going to look like. But this is the most basic of basic illustrations on what it takes to qualify, because there's so much paperwork oftentimes that goes into either conventional or an FHA. This doesn't take into account on a conventional loan that you can do a 1-year average if that business or that specific mode of income is open for 5 or more years. If it's not, then we do a 2-year average. And then it goes into so much more potential paperwork. Is the income declining? Is there a different description about what you're doing? And now you need more CPA letters. So this is just a way more clean, substantially cleaner option to get a mortgage if you're 1099. But there are some caveats. Credit profile has to be clean. No real mortgage lates. We don't want to see lates on the other stuff, other debts, other things of that sort. So credit profile and how you pay your debt is super important. On top of that, 20% down is really the rage here. Sometimes you can get away with 15, maybe even 10% down, but the rate gets so much higher. It's just not worth it. So to me, in these programs, you really have to have saved at least 20% down. It's just a good number, where on a conventional loan, you can get away with 3 or 5% down. It's a little bit of difference there. And of course, post-closing liquidity. Now, just to make it more of a visual, $4,500 a month. That's the max. But say she wanted a $4,000 a month payment, right over here, guys. So if we say, based on her credit score and her credit profile, she's a first-time buyer, maybe, does she pay rent? She lives at home. She can't verify rent. It's a little bit more risk. Lenders say, hey, I want 12 months of reserves. So what does that mean? All it means is if she was buying a $500,000 property, if she was putting 20% down, which is $100,000, that After that, we're giving her a $400,000 loan. After that, we want to make sure that she has 12 months of this $4,000 a month payment. It's $48,000. So we want to make sure that she has $48,000 still in the bank after she closes. Nothing has to happen with it. They just want to see that it's there, because if the what hits the fan, they want to make sure that she's not living, check to check, and she has enough money to potentially cover any type of issues. And what does that mean? Of course, Murphy's Law, right? Something happens with the roof, or maybe your landscaping, or maybe the fence, or the boiler, hot water. I heard that stuff's important. So you always want to make sure in these type of programs they have some money left over. It's a hedge against the uncertainty of Murphy's Law. But wouldn't it be the worst if you're house rich, cash poor, meaning you put all your money into the house, you have no real monies left over, and something happens. Now you're stressed out. You have this amazing house, but you didn't have much money. Now you're putting things on credit cards. So regardless of whether it's required for the program, it always makes sense to have post-closing liquidity or reserves, just for peace of mind, because if anything happens or you need to pull money from anywhere for the house, that it's there for your use. So this program, guys, it changes the game for contractors and those getting a 1099. But there's so many more mortgage options under the non-QM suite. So make sure you click this link. Watch our next video, guys. Click this link. Self-employed, are you picking the right mortgage type? I'm going to dive into all the options, not just one, because if you're self-employed, even if you get a 1099, there's so many more options. So make sure you click the link. Watch the next one.